Welcome to the International Institute for Strategic Studies. We do spend some time here thinking about what constitutes a strategic issue in our definition, and that definition has really anything to do with matters of war and peace. Without subscribing to the view that there's a very plausible scenario where France and Germany go to war again, I think it is still the case that the fate of the euro is a strategic matter that rivals just about anything we do here. And I'm very proud of the coverage we've given to this issue in the journal that I edit, Survival. And I'm joined on this panel by two mainstays of our coverage in Survival. Together, I think they've written about 8 or 9 pieces on the matter. On my left is Erik Jones, Professor of European Studies at the IISS Bologna Center of Johns Hopkins University. He's also the founding director of the new Bologna Institute for Policy Research, also at Johns Hopkins, and he is a contributing editor of Survival. His latest piece on the subject of today's meeting is in the current issue of Survival, and it's called Italy's Sovereign Debt Crisis. He's going to speak for about 20 minutes, and he has some slides. His talk will be followed by a shorter comment from Alex Nicoll, who's director of publications here at the IISS. He's also written extensively on the crisis for our journal. He, before coming to IISS, was a journalist at the Financial Times, where at one point he was Euro Markets editor, I believe. Erik.
Terrific. Thanks, Dana. Thank you all for coming. I know that this financial crisis has probably taught you more about economics than you ever wanted to learn, and it's a problem that doesn't seem to go away. So my main focus today is to try to explain how, despite the fact that we've had lots of diplomatic initiatives and a number of significant agreements, including hopefully an agreement that will be announced soon on the second Greek bailout, despite all of that, there are many economists who are very suspicious about what's been done and very concerned about what this entails for the future. So I want to give you some basic principles that will help you better to understand the suspicion that these economists feel and indeed the problems that we're facing in the Eurozone today. Now, it's a 4-part structure. 4-part structure is fairly straightforward. It's going to tell you what we have, what we need. It's going to tell you why we need different things from what we have, which are the 5 lessons from the crisis, and it's going to end up with where we go from here. Now, there's some data in here, and there are some statistical things that I'll try to walk you through. If you don't understand precisely, I'll make sure that I can boil it down to something that is comprehensible. And since we're going to be talking about data, there are certain points where I'll probably just give up looking at you and not looking at the slides, and I'll stand up and we can look at them together. Well, what do we get? You know, economists have always envied the military for its use of acronyms, and so we've started to come up with our own acronyms and slogans. And what we have right now as the European solution to the sovereign debt crisis is a series of different measures. Probably the most famous is the six-pack. The six-pack was the set of agreements that was reached in March of last year to improve fiscal policy and macroeconomic policy coordination. Now, I say improve fiscal policy and macroeconomic policy because one of the things that we introduced into the conversation was a sense that it was a macroeconomic problem as much as a fiscal problem, and indeed the macroeconomic problem and the macroeconomic rebalancing is going to be in many ways more important as a long-term solution, and I'll explain why that's the case. We also have the new liquidity on offer from the European Central Bank. In December, the European Central Bank offered unlimited amounts of liquidity to banks at 1% interest over a 3-year time horizon. They took up about 1/2 of 1 trillion euros in December, and we expect them to double that amount, to take about 1 trillion euros worth of liquidity in February on a 3-year maturity. And they're going to do this in order to stabilize the banking system, to make sure that the banking system remains liquid, and if possible to get the banks to reinvest some of that money in sovereign debt so that sovereign debt markets remain liquid as well. The most recent agreement is the fiscal compact. This is the one that Angela Merkel basically drove through the European Council with the assent of 25 member states. There's some disagreement in the Czech Republic that centers on the president, and some disagreement, obviously, in this country as well. What you should know is that there's very little that's new in the fiscal compact beyond what was already agreed and indeed implemented in the six-pack. The big difference is the threat of legal sanction, a threat of legal sanction that's triggered not by the Commission going to the European Court of Justice, but by one of the signatories, one of the member states, turning on another member state. Now, unfortunately, this procedure is not one that has been very popular at the European level ever in the history of European integration in other legal areas where this infringement procedure is available. I think only about twice have member states actually taken each other to the European Court of Justice. The Commission, by contrast, brings many cases against the member states. So the fact that they denied the Commission the ability to bring cases suggests that the enforcement is actually going to be much weaker than the rhetoric that surrounds the fiscal compact would have us believe. The last thing that we've got from the Europeans is the European Financial Stability Facility and the European Stability Mechanism. These are our firewalls. They're pools of money, the first temporary, the second permanent, that we use in order to stabilize government finances to replace the financing that states in trouble can no longer get from the market. So this is what we have, and if you think about this from the perspective of the start of Europe's economic and monetary union, each aspect of this is innovative, right? The fact that we're looking at macroeconomic policy coordination beyond fiscal policy coordination is innovative. The fact that the European Central Bank is providing so much liquidity is innovative. The fiscal compact is not really all that innovative, but we had to say something nice about it. So it's innovative. And the EFSF and the ESM are very innovative. That's something that we didn't ever expect to see and yet nevertheless have. The problem is that it's not enough. And what economists will tell you time and again is that we need a bigger firewall. We need more money, either in the ESM or by combining the ESM and the EFSF. These firewalls have to be in place because if any larger country or even a significant number of small countries runs into trouble, we simply don't have the resources to stabilize their finances to prevent them from going into a crisis. So the debate right now is about the size of that firewall. And you'll have seen Christine Lagarde, the managing director of the IMF, insist in her speech in Berlin that the firewall must be significantly larger than it is today. You'll also see that Christine Lagarde argued in favor of the mutualization of sovereign debt. This is the whole Eurobond debate. And we know that this debate is not flying in Germany, so you've got to ask yourself, why do we keep coming back to an issue that seems to be rejected in such a significant way? And the answer is very simple. It has to do with the flight to quality in Europe. The big thing that differentiates Europe from the United States is that when investors get scared in the United States, they move across asset classes. When investors get scared in Europe, they move across national boundaries. And what we need is some way to channel that flight to quality, and I'll explain that in greater detail later, so that it no longer moves across geographic boundaries, because if we don't do that, this crisis is set to repeat itself at some point in the future. Now, why do I believe that? I believe that because of the 5 things that we've learned from this financial crisis, 5 things that relate to the origins of those macroeconomic problems that we experienced, the implications that these origins had for relative cost competitiveness across European countries, the balance of power between borrowers and lenders within the European financial marketplace, the structure of the flight to quality, I promise I will come back to that, and the relevance of U.S. experience. And this is a point that I throw in just to reassure you that although I'm American, I don't think that all the answers come from the other side of the Atlantic. So what's lesson number 1? Lesson number 1 that we have learned is that the macroeconomic imbalances that arose and gave rise to this crisis did not derive from cost competitive concerns. They derived from the flow of capital across countries and the rapid nominal interest rate convergence that preceded Europe's economic and monetary union. It was capital market integration, not the introduction of the euro, It was developments in the 1990s, not developments in the 2000s, that set this crisis in motion. Let me explain. This is where the statistics come in, and I do apologize. If you look at the dotted line that says long-term interest rates, and you look all the way down at the bottom where you see the years, what you'll see is that the standard deviation across long-term interest rates in Europe collapsed in the 1990s from a standard deviation of about 5% down to less than 0.5% before the single currency was introduced. What that means is that long-term nominal interest rates got closer and closer together across countries. And as that happened, countries that traditionally had very high long-term nominal interest rates suddenly found that they were awash in cheap liquidity. And they began to use that money for consumption, for investment, for government spending. And as they did, they outstripped their own output. In other words, they began to import stuff from abroad. Because they had the money available, they were able to buy more than they produced. And their current account went into significant deficit as a consequence. That's the solid line. What it shows you is that with a lag, the variation in current account performance increased dramatically across countries, with some countries running significant surpluses and other countries running significant deficits, as capital moved from places where savings was in abundance to places where investment opportunities were more robust. Now, this is how it happened in Greece. You see, the argument is that as nominal interest rates decline, your current account goes into deficit. And you can see that very clearly. If you look at the solid line, which is all the way over to the left, you see in the 1990s that Greece's nominal long-term interest rate declines from about 25% all the way down to about 6% in the 1990s. That's a pretty impressive decline. Over the same period, but with a slight lag, look what happens to the current account. That's the dotted line, and it refers to the right axis. And what you see is that they go from balance, a current account equal to 0, to a deficit of about 12% of GDP. That's before they entered into the euro. Before they entered into the euro, their deficit in current account was equal to 12% of GDP. Why? Because they got suddenly so much access to liquidity that they used for investment, consumption, and government spending. Now, this is not to say that there aren't competitive problems in the Eurozone. You'll have heard this story time and again about how Germany's competitiveness increased. That's the little blue line all the way over on the left-hand side of the screen that goes down. That's an increase in competitiveness. And Germany's current account goes into surplus. That's the red column that goes up. About 28% of GDP over the period from 2000 to 2007. That's a pretty significant surplus for Germany. Look at all these other countries. Their blue lines go up. That's their real effective exchange rate appreciating. And their red lines go way down. That's their current account deficits. And as a matter of fact, in 2007, if we added up the current account deficits of the countries that were in deficit and the current account surplus of Germany, we would find that they were exactly equal, one offsetting the other. Kind of interesting. Not saying that that's all due to Germany, but I am saying that there is an offsetting, which explains why the Eurozone itself is in current account balance with the rest of the world. The problem with the competitiveness story, though, is that it assumes a lot of things that actually didn't happen. Look at the relative world market shares. If we look at the countries that are in deficit, their relative world market share actually holds up better than Germany's. If we index it all the way back to the start of German unification, what we find is that Germany suffered a huge loss of competitiveness in the 1990s that it only just barely recovered from in the 2000s, whereas our smaller peripheral countries actually benefited a lot from the decrease in their cost of capital and were able to sustain their market share as a consequence. They were importing more, but they were exporting just as much as they always had. And it's not just in terms of market share. Look at the manufacturing employment. Our peripheral countries have stable manufacturing employment over a 17-year period, and Germany's manufacturing employment declines dramatically. Now, remember, in 17 years, about 40% of the manufacturing population turns over due to retirement. So this is not rigid labor market legislation. Workers who retire are being replaced. The reason that manufacturing employment is stable in these peripheral countries is because they had a low cost of capital. They could afford these workers. They could use these workers to maintain their export market share, which we've already seen. It's not a competitiveness problem that got them into trouble. What got them into trouble was financial market integration. This brings us to lesson number 2. Now, I've said that there is a competitiveness problem, and the lesson is that the divergence in competitive performance is actually a result of the macroeconomic imbalance and not a cause. So they have a competitiveness problem now. I'm not denying that. But the competitiveness problem is the same origins as the crisis itself. And you can see that by decomposing this thing called the real effective exchange rate into relative movements in nominal exchange rates, GDP price inflation, and the ratio of wages to nominal GDP, which we call the real unit labor cost. It's a directly observable variable, unlike most real variables in economics. This one you can actually see and measure. And what you see is that Germany's competitive position actually improves dramatically under the euro. It lost competitiveness in the 1990s, that's that upward movement, and then it regained it in the 2000s. And the reason it regained it is because Germany had such significantly lower GDP price inflation, which is this one right here. And it had that nominal wage compression that we all talk about, the decrease in nominal wages as a ratio of GDP. So Germany's competitiveness improved dramatically. But look at what happened to Greece. Greece lost less competitiveness under the euro than it lost before the euro. Because even though it had this nominal exchange rate variability, that was more than offset by the huge increase in relative price inflation. Every time the currency devalues in Greece, prices across the Greek economy explode. Greece doesn't benefit from devaluation. It loses competitiveness as a consequence. And as a matter of fact, those Greek workers that we keep hearing complaints about, well, their wages were roughly stable relative to nominal GDP. They didn't lose competitiveness. Germany gained competitiveness as a result of this strange change in financial flows. Why? Well, because when you have more money in your country than you produce in terms of goods, then prices do increase. They don't increase as much as they do when you devalue your currency, but they still increase by more than they did in Germany. And that's the problem. We could see the same thing with Portugal. Look, they lost less competitiveness in the 2000s than they lost in the 1990s, and for exactly the same reasons. Even in terms of relative real unit labor costs, Portugal is flat. They are the good guys. They didn't lose anything. Germany just gained hugely in terms of competitiveness. Nevertheless, they did become accustomed to a very low cost of capital, and that low cost of capital has now been taken away from them. So these countries are suffering now because they have to pay a lot in terms of interest, and they can't afford the investments that they made at these new, much higher nominal interest rates. This brings us to the last thing. You know, lots of people complain these countries never should have borrowed that money, but the fact of the matter is it's much easier to make countries borrow than to make them lend. This is what Germany is discovering right now, right? Germany is receiving money from the rest of the world. Germany is borrowing because people are flooding into Germany to buy German sovereign debt. The same thing happened to Italy, Greece, Spain, and Portugal in the run-up toward economic and monetary union. As foreigners came in to buy Italian sovereign debt, they priced out domestic investors. So they were forced to borrow this money by foreigners coming in to buy the debt, and these domestic investors who no longer saw the debt as such an attractive investment went out and looked for other investments. The share of foreign-held Italian debt increased from 5% to 25% in the 7 years before the onset of the single currency because foreigners came in to buy it. When foreigners come and put deposits into the banking system of these peripheral countries, the banks have to lend that money out because that's how banks make money. They take deposits and they book assets. Now, there was no interest in the banks of these peripheral countries to try to book assets back in Germany to offset the deposits that they were receiving from Germany. Instead, they booked assets domestically, but that meant that they were reaching into new lending markets domestically, people that were untested, people that had been priced out previously and suddenly found that they were able to borrow. It's not irresponsible lending. This is what we tell banks they do. They're supposed to take deposits and book assets. The problem is that the deposits were coming from abroad. And then suddenly the deposits disappeared and the banks found themselves without money. And now the banking systems of Greece, Ireland, Portugal, and Spain survive only on the resources that they get from the European Central Bank. The European Central Bank provides all the liquidity that these banks depend upon to service the assets that they acquired during the financial market integration of the 1990s and early 2000s. It's that flight to safety that goes across geographic boundaries that matters. And that's why the story that I tell about Italy is so significant. What you should know is that Italy's current account deficit is actually very, very small. Italy doesn't borrow hugely from the outside world. It has a big government debt, but the problem for Italy is that the foreign holders of that big government debt have suddenly decided to sell into the market, and there are no domestic buyers, despite the huge pool of domestic savings, for debt that looks like a bad investment. That's unsurprising, but nevertheless, not being surprising doesn't mean it's not a problem. It's a huge problem. It's the problem that brought down the Berlusconi government, and if a politician as wily and canny as Silvio Berlusconi can be brought low by this problem, you know it's a problem that's difficult to manage. What we need to do is to figure out a way to stop this geographic flow of money in the event of uncertainty, because the sources of uncertainty are many in Europe today. Look at Portugal. Look at that second Greek bailout package that I mentioned. If either of these things fail, if there's a private sector involvement in Portugal, more money will flow out of Italy, also from Italian savers who are looking to protect their own assets from a collapse in their domestic economy. Now, how do we solve that? I said that the big difference between Europe and the United States is that in the United States, the flight to quality takes place across asset classes, and in Europe, it takes place geographically. And I maintain that that's the only important distinction. But many people may argue that the United States has more integrated labor markets, and it has a federal fiscal system that transfers resources. And what I'll suggest to you, again with data, is that neither of those things are relevant to the U.S. experience today. And I'll do that by using my own state of Texas as an example. You see, Texas is a place that used to be on the upswing. It's the red line in terms of wages and salaries per capita. And what you see is that in the 1970s, Texas got rich on the back of the oil price shocks and the boom in the banking industry. But suddenly, all of that went into reverse, and terrible places like New England benefited. We don't like New England in Texas, but you'll notice that there's a huge shock to Texas income. The red line goes down, and the New England income soars up. This is precisely the kind of shock that we're witnessing in Europe today. So how did the U.S. fiscal system respond? This is an income or an employment version of the same shock. What you can see is that not only did income increase in New England, but employment prospects per capita increased in New England over Texas as well. So more people in New England per capita have jobs, and more people have money than they do in Texas. It's a terrible, terrible state of affairs. What does the federal government do about it? Well, what you can see, if we put transfers per capita into the picture, is that as New England income increased relative to the national average, New England transfers from the federal government increased relative to the national average as well. That's that red line up there. So New England gets the money and it gets the transfers. Whereas in Texas, our income declined and our transfers are even lower per capita than our income. We are giving money to New England at a time when our incomes are lower and our employment prospects are worse. That doesn't make any sense. This is what the labor market says about that. Now, you would think that people would go to the place that has higher income and more jobs per capita, but in fact, the food in New England is terrible, and it's great in Texas. So we got exactly the reverse. We got lots of people moving to Texas, holding down incomes, and flooding the labor market, whereas in New England, it's cold, the food is awful, and so nobody goes up there. They get to be rich and employed, but they don't have the quality of life we have down in Texas. This is what integrated labor markets did for us. This is what the federal transfer system did for us. Europe doesn't need this. What Europe needs is actually something very simple. We need to keep these integrated financial markets because we don't want excess savings in Germany going to waste. We want it to be invested in the periphery of Europe to make those countries wealthier and more productive. That means that we need to help them to ensure that they do make good investments, and if we can encourage market structural reform in Italy, Spain, Ireland, and Portugal, then all the better, right? So I think that what we're doing right now in terms of investments and market structure, I think is a really good thing. We should stabilize that by stabilizing the banking system, introducing common deposit insurance, and we should also create a common risk-free asset. I actually believe the Eurobond proposal is a good idea because it will help us to avoid this crisis in the future by keeping money from flowing naturally across geographic boundaries and channeling the flight to quality across asset classes instead. What we're going to get, though, is not that. As much as I might prefer that as the option, what we're going to get is just more liquidity from the European Central Bank. And this liquidity, in terms of the €1 trillion offering that we're expecting at the end of February, is going to make the problem look like it's going away. But in fact, the problem, the very conduits that created this crisis, will all remain in place. So the situation will get better as a palliative, but it's not a cure. We're also going to get more austerity, and I think that this is unfortunate. You see, just like competitiveness was a result of the crisis and not a cause of the crisis, much of the fiscal problems we see outside of Greece will keep as a separate case, much of the fiscal problems we see outside of the Greece were a result of the crisis and not a cause of the crisis per se. We need to manage that, but much more important, we need to build the stable system wherein that doesn't recur. And while we're pushing those austerity measures, we're actually going to be hurting some of these countries that are struggling to adjust. And so I expect there to be more uncertainty around the fate of Greece, more uncertainty around the fate of Portugal, and more uncertainty around the fate of Ireland as all of these countries struggle to meet their European suggested fiscal targets. And I'll leave it there.
You exempt Italy.
Well, I exempt Italy because Mario Monti is awesome. Right?
Alex.
Well, thank you very much. That was absolutely masterly, and I can't possibly hope to match that. I'm not an economist. I'm just a close observer of this crisis over the past few years. And I just want to offer kind of three sets of very short points on how I see where we are now. I mean, there is no doubt that the situation has eased, and that's because the European Central Bank did bring out the big bazooka that everybody had been calling for a long, long time. And in fact, the funny thing was that when they brought it out, nobody noticed. And that's because they didn't do it in the way that people were expecting. They'd been being asked to pump billions and billions of euros into government bonds, into the government bond market, and they chose, for German reasons, not to do that. But instead, they injected a huge amount of money, and as Erik said, probably they're going to inject even more money into the money market. And I think that in doing that, they actually attacked the crisis much more fundamentally. Because you've got to think, why is a debt crisis a debt crisis? If borrowers are not able to pay back what they owe, who does that affect? It affects the banks. And the problem is a problem. It's a crisis because large banks could collapse, depriving us of our savings and causing many other bad consequences. What we saw was a loss of mutual trust amongst banks. It's what we saw in 2008, and it's what we also saw in the second half of last year in Europe, and no doubt still going on. So the answer to that is a wall of money. And that is what to ensure that banks have liquidity and they don't go out of business while debt issues are worked out. And that's what the ECB is now providing. And it has considerably dissipated the desperateness of the situation. In a sense, it's not an immediate crisis anymore, barring accidents. Accidents can happen. So does that mean, secondly, that the crisis is over? Well, certainly not. We obviously still have a chronic economic and financial problem. But I think the very nature of this crisis is it can't be solved with a single agreement or in a month or even in a year. The fact is that we're still working through the consequences of the 2008 financial crisis, which was a massive shock that caused huge losses. And after it's a classic crisis, and after a crisis like that, the question is, how are the losses going to be shared out? Central banks, as it were, hold up the dam, while everybody below the dam makes their arrangements and allows the water to come over in ways that will cause the least damage. There's no way to avoid everybody sharing in the damage, in the losses. Obviously, bank shareholders take their share of them. Taxpayers do because they've got to shoulder the costs caused by a drying up of credit. And citizens in general suffer lost jobs. And what crises do is to catch out those who were vulnerable anyway, as Greece was in particular, because it was understating its budget deficit. Now, in the case of the so-called peripheral countries, which, as Erik very well indicated, were not in uniformly bad shape before 2008. They were suddenly unable to borrow money externally, or else they could only do so at much higher cost. So everybody's had to curb their financing needs and find help in raising money. And that's where the efforts of the European governments to coordinate their responses and find the money come in. Now, you could certainly say that European governments contributed to the desperateness of the atmosphere during the crazy second half of last year, with a series of agreements that seemed to be outdated or even irrelevant. And in fact, what we also saw was a series of international and domestic disagreements. Because of political obstacles, governments seemed to be failing to put the required resources to support the ends that they said they wanted. And that did lead to a sense of a situation running out of control, with all the predictions of the breakup of the euro, the deep recession and so forth. In my view, those were all overstated and in fact hysterical. But that doesn't mean that those kind of feelings in the markets and in political circles couldn't recur. But as I say, I think they've been dealt with for now. So finally and briefly, I'd just like to run through quickly some of the ways in which I think Europe is different now as a result of the Eurozone crisis. And these will be more in the nature of assertions than arguments, and you're welcome to challenge them. And of course, they could be wrong. First of all, I think the Eurozone, and Erik's already talked about this, it changed significantly because each of its members now has to pay market interest rates for its money. And as Erik showed, the euro didn't start out like that. In fact, it even before the euro was created, it was adjusting to a single currency. Interest rates were basically uniform across the euro area, and that obviously proved to be unrealistic as the markets began to perceive that some euro members could actually have to default. Now, if and when trust in the euro as an entity is renewed, and if economic policies do become more convergent, then the spreads within the Eurozone should narrow again, but surely they won't narrow again to zero or near zero. I think the differentials between interest rates are healthy because they make policy making more realistic, and interest rates can act as an alert to governments that they need to adjust their government policy. And as Erik also mentioned, the uniform interest rates that we had clearly contributed to the imbalances that developed across Europe. Secondly, we may actually see more economic convergence being imposed, partly as a result of the fiscal compact that 25 countries have agreed to. Of course, we did have Stability Pact before, but it didn't have much of an effect. But I think there really has to be real political will to achieve this. But what I would say, to borrow the title of my own article in the previous issue of Survival, is that we've already been seeing fiscal union by force. That's to say that the markets were already dictating, forcing countries to introduce greater fiscal discipline. If you think Britain's not in the euro, but it's introduced an austerity program so that it doesn't go the way of Greece. Clearly it's a powerful incentive. The problem for some countries is that carrying through these austerity measures that we're going to continue to see is very difficult politically. And in the extreme, in this crisis, what we see is Germans dictating how Greeks will live. And that's clearly absolutely politically intolerable. So I think the fiscal compact can have a good effect because it may create the institutions within the European Union that allow these unpalatable measures to be implemented in a more politically palatable way. I think that will be all part of restoring trust and confidence, which is vital for the future of the euro. And Erik mentioned Eurobonds. I think Eurobonds can be part of the solution, but only after the trust has been. So they're not a means of restoring trust, but they symbolize the trust once it's been recreated. So finally, my last two assertions, they might seem contradictory, but I don't think they are. I think the euro will stay together because I think the political, economic and financial costs of it not surviving are too great. We have to take Chancellor Merkel at her word when she says that if the euro fails, then Europe fails. It will need bigger firewalls. On the other hand, I also think that national politics are going to remain predominant. If you just consider Erik's excellent exposition in Survival of the domestic Italian politics and economics that fashion Italy's particular position, we're not going to have the integration of the United States. Each country is unique and will continue to be so. And this means that it will always be, as it has been in the European community since the beginning, a matter of working towards tedious and time-consuming compromises that go just as far as everybody can agree on at any one time. It's frustrating, and in a crisis, it's sometimes scary, but there it is.
Okay, well, thank you both very much. I have many questions. I have two questions. I'd like to pose one question to each of you, but ask you to hold on to them because I don't want to monopolize the discussion. And then I'll take a couple more and then answer them. Erik, it seemed part of the theme of what you were arguing, it seems to me, was don't blame the euro, if I understood that correctly. Well, I guess that sort of raises two questions for me. I would need to understand a little bit more why this interest rate convergence predated the euro. To what extent, I mean, now I can't even remember the history, but, you know, I mean, the Berlin Wall fell and people started talking about crazy schemes like monetary union very quickly, but obviously the question is to what extent was it in anticipation of a single currency and monetary union, and what were the other factors? In any event, so this is really two questions. Even if you don't blame the euro for causing the problem, isn't it in some fundamental way a bar to the solution? And the solution being, I mean, maybe the solution now is this fire hose of liquidity from the European Central Bank, but a real solution would be an Italian central bank that could act as a lender of last resort. I'm not saying we can get there now, but I mean, to me, it does seem the fact that the Italian central bank can't do that is a problem. Well, Alex, my question is one that we've debated many times, but I mean, I wasn't going to do this, but I mean, you set me off a little bit by comparing Britain to Greece. I mean, look, Britain is not Greece in so many ways, and you know, it's the old question, and maybe it's getting to be a tired question. But isn't Britain committing suicide for fear of death? Very simply. But anyway, I'd answer those three questions at some point. But I'd like to open it to the floor. Yes.
Imke Henkel's Focus, a German news magazine. I wanted to ask you both, actually, about the German political leadership. I think you actually said that in the extreme, Germans try to impose and dictate Greeks how and what to do. And that, of course, is politically not acceptable. But the renewal of the Stability Pact seems to go in a very similar direction. And actually, to put it provocatively in both directions, is there too much German leadership, or is it possibly too little? Okay,
I haven't actually strategized how we're doing this, but let me take one more, if that's okay, and then we'll revert, and there are a lot more to come. David Buchan.
Thank you for the two presentations. My brain is still trying to run after and follow them. But two questions about the sort of a post that would come after a crisis solution. So once the immediate crisis is solved, Erik, you basically you made a powerful argument how the bond markets in a way fail to do their work. They fail to detect the differing performances and behaviors inside these Eurozone countries, and effectively flooded Southern Europe with a lot of capital and basically, I guess, raised prices and wages, whatever. Alex forecasts, and I'm sure this is right, that the bond markets have, once this is over, have learnt their lesson. They will, as they are now, very sharply distinguishing between the different economies, and they'll look at each one separately. But even if that is the case, in the future, surely there will be some changes in cost competitiveness. I know you underplayed it, but for instance, the German Teutonic discipline in Germany, high savings rate, something of an aversion to credit, will over time again increase German competitiveness. So what would be I'm not quite sure what would be the adjustment mechanism that would work in the future. And I suppose my other question is just, do you have any, this is called the implications of the euro crisis. I just wonder whether you have any thoughts on the geopolitical implications of this. If the crisis is, the settlement is, because you suggest that the recipe of austerity is not exactly apt, so it's going to be, it seems to me, we'll face a period of stagnation. Could Europe end up like Japan, that long period of stagnation in the Japanese economy, which led in a way to the political irrelevance of Japan?
Okay. I think we got about 6 questions on the table so far. So why don't you address them as best you can in the next in a few minutes, and then we'll continue.
Okay, I'm just gonna talk very quickly about 3 different things. One is about nominal interest rate convergence, why interest rates converge across countries. You remember the whole process starts at the end of the 1980s with the decision to integrate Europe's financial markets. And the reason they wanted to do that was because there were countries that had lots of savings and other countries that had lots of investment opportunities. You know, if you think of a country with very low productivity, that's an investment opportunity. All you have to do is take good equipment and stick it in that country which has low productivity, increase its productivity, and you can pay off your investment, right? This is what financial market integration is supposed to do. It's supposed to move money from places where productivity is high to places where productivity is low so that they can take advantage of the change in, or the difference in technology across these two places. And that's supposed to lead to real convergence. Well, the problem is that when you do that in an environment where financial markets are structured much more by interest rate swap contracts than by actual flows of money, what you find is that bank treasurers put on convergence trades using interest rate swap contracts that cause the interest rates to converge actually quite dramatically. And the people on the other sides of those trades who bet against nominal interest rate convergence, they blow up, right? So they don't get to stay in the banking business much longer. And as the bankers put on these convergence trades, they were putting them on not just inside the Eurozone, but across Europe as a whole. We saw convergence take place with Turkey, with the countries of Central and Eastern Europe, with the countries of Northern Europe that stay outside of the Eurozone. Everybody had the same interest rate because it was a winning proposition, and it remained a winning proposition for a long, long time. Now, this is where Alex's point comes in. He says, well, you know, the financial markets mispriced risk in that. You know, we all know that the financial markets can remain irrational far longer than most of us can remain solvent. Right? And this is just a situation where that happened. It made sense to put these trades on at one point, but after a while, the sense evaporated, and the financial markets drove us to a situation where people were overextended. Actually, that would have been okay. The guy who's a finance minister of Portugal right now, Vítor Gaspar, when he was head of research at the European Central Bank did a general equilibrium model that showed in about 70 years this whole thing would reverse itself and we'd all be better off. If we could have just been a little bit more patient, then we'd be okay. And the problem is that we weren't patient, we got scared. This is where we get to the point about German leadership. I did a piece in Survival that Dana encouraged me to write that was called Merkel's Folly. And the folly was not that Merkel is a bad political leader. She's an excellent political leader. She's a very daring politician, particularly in her own country. She shows tremendous leadership. But the problem is, I think she underestimated the long-run consequences of not supporting Greece early on in November and December of 2009. I think she just underestimated that. She had very good political reasons not to support Greece then, to do what Per Steinbrück had done in February of that year and say, Greece will never go bankrupt, and the financial markets would go, oh, okay, good. We don't have to worry about that anymore. She didn't do that. Instead, she said, we're not going to talk about Greece. It's Greece's problem. And that terrified the financial markets. And the terrifying of financial markets only increased up until March when they had the European Council Summit in 2010, when she said, as an ultima ratio, we will only bail out the Greeks if they lose access to private capital, which was an invitation for people to sell their exposure. And the Greek bond yields went right through the roof. Now, is that too much or too little German leadership? I don't think it's a question of quantity. I think the problem is that she made a very small mistake at the beginning, and the compound interest on that mistake quickly overwhelmed her in the end. Well, I mean, the Eurobonds thing, the problem is that the political conversation in Germany has been allowed to shape the Greeks as unworthy. And once you say people are unworthy, why would you want to share an asset with unworthy people? That just sounds silly. And by not stepping on that conversation early on and explaining that the Greeks are worthy, most of you probably don't know this, but the effective retirement age for Greeks is higher than it is for German. The Greeks work about, 500 hours more a year than the average German. I mean, it's crazy. All that data is in the article I published with Dana. And yet none of that data entered into the German political discourse, as a consequence of which now we have German politicians who openly say Greece should leave the euro without even considering the dramatic consequences that would represent. And that brings me to the third point, which is about the big bazooka. Dana asks, does the euro represent the solution or the problem, or is it sort of neutral to this whole thing? Well, the euro actually has saved us from exchange rate volatility that would have severely damaged the functioning of the internal market. European trade would have been significantly disrupted if everybody's currency was going up and down as a result of this flight to quality per se. The euro also provided the conduit that allowed us to stabilize countries even outside the Eurozone. Sweden, for example, was bailed out by the ECB because of its exposure to Latvia. So 2 European Union countries outside the Eurozone were stabilized by the existence of these common European facilities. So the euro is actually a really good thing in this situation. There were countries outside that didn't have the euro that suffered and then tried to reconsider. But politically, it's not getting any credit for this. As a matter of fact, if we look at the trust in European institutions, the situation is dramatic. Not only has distrust increased above trust for all European institutions, but the European Union as a whole performs worse than any of its institutional components. It's as though you add up distrust as you aggregate these institutions. And that's where the big bazooka becomes important. The big bazooka is not what we're seeing in the LTRO. The big bazooka is when the ECB steps in directly to sovereign debt markets and puts a floor on sovereign debt prices. Italy's bond yields now are lower than they have been since December the 4th. And the reason that they were so low on December the 4th is because Mario Draghi gave a speech to the European Parliament where people interpreted the speech to mean that he was going to bring out that big bazooka. And within 3 days, Italian bond yields collapsed. And everybody went, yay! And then Mario Draghi said, okay, now I know it works. I'm not going to bring it out, right? And Italian bond yields soared back up to 530 basis points again. We've got the small bazooka out right now, but the big bazooka is waiting.
Well, I'm not sure it's coming, but anyway. Dana is the UK committing suicide for fear of death. I think one of the things that this crisis has introduced is a kind of moralizing of the issue.
You looking at me?
No, I'm not. Not at you specifically, and I think it's actually been done partly by Germany and the German finance minister by sort of indicating that bad behavior requires discipline. The fact is that countries became overextended. It happens, and many recessions have been seen before, and they've all been dealt with, and this will be no different. I mean, I just feel that countries that find themselves with a high budget deficit for whatever reason, well, they're going to need to do something about it. Otherwise, their access to finance is going to be restricted. So I just don't think that all countries across Europe, including, well, most countries actually, and some of them are in good position, but most countries, including Britain, have any option but to introduce austerity measures. It's not. I mean, the question is how austere is austerity? I think that's probably perhaps a different question. And I think that, as we've seen in previous recessions, once you create a more competitive economy, then growth resumes. So I just think that's where we are. Now, then the question about Germany's position. I mean, I think, the fact is that German resources are needed to sort out this problem. And, of course, it's in Germany's interests to do that, to provide resources to other countries. If you think about it in the broader context of the European community and later union, actually rich countries within the European Union have been channeling money to poorer countries in the European Union ever since it started, and that's part of the European Union. And so this is simply doing it in another way, in a sort of more crisis mode. I think that then the question is how you make this all politically tolerable. I do think that although the fiscal compact obviously contains elements of actually Germany setting conditions, what you're doing, though, is you're hopefully in time setting an intermediary, i.e. the European Union, its institutions, to act as a sort of mediator, moderator, and to make it politically palatable for difficult things to be done. I mean, maybe it will work, maybe it won't, I don't know. I think on David's first point, of course, we're not going to see a completely integrated single economy, as you suggest. I mean, there are going to be. It's unrealistic to expect Greece to be Germany. It will continue to be unrealistic to expect Greece to be Germany. So again, the question is how the mechanisms that you have to introduce to adjust that. I think as Erik indicated, there are tremendous advantages to having the euro, but what you lose is some of the leverage that individual countries normally have to deal with economic problems. So it's a trade-off. The question is, does that trade-off continue to be beneficial? And then it's a political judgment in the end within each country as to whether it is or not. And on the just very briefly on the sort of geopolitical question that you asked, I think the crisis is not the only thing that is happening in the world. I think that Europe in any case has difficulty acting as any kind of unified actor in the world, as we saw with Libya last year. So this is just another thing. If the euro does work, and you do have greater convergence, it implies some more political convergence. So it could, if it all works, you could have Europe in some ways acting as a more concerted actor in the world, which may be good for Europe. I don't know.
But I just would add one thing there. The time is out of joint in terms of, or to put it a different way, there's kind of a pro-cyclical retrenchment going on right now, in the sense that the United States has a president and an administration that clearly feels we were overextended, and withdrawing from Iraq, getting out of, setting very clear, making it more and more clear that the drawdown from Afghanistan is going to happen on the timeline that was set out. And in other ways, hoping to, kind of revert to the role of an offshore balancer rather than a policeman going around and dealing with every problem. And part of, I think, what you see in the administration is a view that, you still need this global good of international security provided by an international community. And what is that international community? It's the United States and Europe in the first terms and military terms. And so there are expectations in Washington of a European role that don't actually compute this lost decade that you were alluding to. On the other hand, it sort of worked in Libya. I mean, that was the first test case, and despite being sucked into a lost decade, Britain and France were willing to step up. You wanted to say one quick thing, and then I'm going to take 3 more questions, and then we'll have to...
Just real quickly on this, on the ethical dimension, the internet is an amazing thing, and I went and found a copy of the Bible and searched it for debt, borrow, lend, all related words, and what I discovered is that there is no biblical injunction against borrowing, none. But there are biblical injunctions on lenders. You're not allowed to charge too high a rate of interest. You have to let your borrowers off every 7 years, the 7-year release where you forgive their debts. And there's even a passage in Exodus where you have to give back the collateral, right? So I think on the ethical side, we've got a pretty clear-cut case.
Okay. Yes, I'm sorry I'm not going to be able to take all of you. I'll take, you were the first one I saw. I'll start there and then weave through.
Professor Jones, in 2008 we saw that mortgage-backed securities created a lot of toxic debt that did a lot of damage to the financial markets. I personally can't see the difference between a Eurobond and a mortgage bond because what you're essentially doing is putting different classes of differently rated debt into one package. People buy it at one point in time, and we don't know what could happen later on. Secondly, if I was, let's say, a bond trader for Deutsche Bank, and I bought a Eurobond, I would then splice and dice it and say, there's a super safe Eurobond where I take 90% of the asset and say this is all AAA, and the other 10% is what we call peripheral Europe, and I'd sell that on the junk bond market. So I don't think it would solve the problem. I mean, I'd just like your views.
Okay. In the far back, yes.
A question for Professor Jones. Perhaps I misunderstood what you were saying, but I think what you said was that there's a lot of hot money going into southern European economies, and the problem was geographical financial integration. But surely the problem, and that you were arguing against that, but surely the problem there is the Treaty of Rome, which talks about the freedom of movement of capital, is the essential principle of it. And perhaps I misunderstood you, but are you advocating some kind of form of financial protectionism?
And right here, I'll take 2 more. The gentleman in the front, and then the gentleman right there. And I apologize to everyone.
Thank you. I'm Kyo Fuji from Nikkei, Japanese newspaper. My question is also to the Mr. Jones, and I'd like to know your view on the international support outside Eurozone to build up the firewalls. For example, U.S., U.K., or other surplus countries like China, Russia, or Japan.
And then right behind you there, sir.
George Harnett from Record Currency Management. When you talk about the euro, you talk about it as a positive force, and you say that it doesn't have, it in fact has given support during the crisis. But in some ways, you're disaggregating the euro from the structures that were put in as a necessary result of the euro, such as the ECB, which have in many ways damaged the response to the crisis. So the ECB forced the zero-risk weighting of all Eurozone sovereign debt, for instance, which artificially deflated yield further and created more of this sense of risk-free borrowing for peripheral countries, and has prevented the lender of last resort solution of just printing money, which an Italian national bank could have done and a Greek national central bank could have done. There's also the fact that you talk about the euro preventing these disruptions to the internal market and exchange rate volatility causing disruptions to trade, but aren't disruptions to trade just your way of talking about trade rebalancing, which is entirely necessary considering the significant now competitive differences, whether or not they were the cause or the result of the crisis? There are now differences in competitiveness, and exchange rate volatility is traditionally one of the ways in which trade is rebalanced to correct those.
Okay, with my deepest apologies to those whom I wasn't able to call, I think that's a full plate. It's all to Erik. Alex, you can say if you want to add a few words at the end.
I'll start with the easy one. I believe we should have integrated financial markets, and that's why I say what we need is some mechanism to make sure that having integrated financial markets doesn't reset the machine, right? Because what we're moving toward are disintegrated financial markets right now, and that would be bad, right? The more complicated question is about the technical structure of the Eurobond to prevent it from looking like an MBS. We do have institutional proposals to achieve that goal. And they're probably a little bit too complicated to go into here. The best exposition of these institutional proposals has come from the Bruegel think tank, the blue bond, red bond proposal. That's probably not going to be adopted. The European Commission in its green paper is considering many different design structures, but we could certainly come up with a design that didn't have the consequence that you anticipated. And part of the reason that we could do that is because of this point about collateral rules. You see, the European system of central banks inherited all of the collateral rules of all of the corresponding institutions. And that actually proved to be a boon in the early days of the crisis because banks with all kinds of weird assets could still get access to liquidity, unlike the Northern Rock, which couldn't get access to liquidity in this country and had to seek special arrangements that ultimately led to the run on the bank. So the lax collateral rules were originally viewed as a positive thing. As everybody else was relaxing their collateral rules, the European Central Bank actually was tightening its collateral rules up until the Lehman crisis. And it was in the aftermath of Lehman that we began to look at these collateral rules as the big firewall or the break point. When a country lost a single A rating, it would no longer be eligible for collateral, and that went out the window obviously when Greece had trouble. You'll find in the May declaration of the European Central Bank in 2010, it initially said it would accept Greek collateral debt as collateral no matter what its rating, and then it went down all the way into the junk zone as long as it's not in default. Now, is this a problem for the European Central Bank? I think the European Central Bank has actually done a reasonably good job responding to the crisis. The crisis has been a very unusual crisis, and it's involved a lot of innovative experimental policymaking on all sides. And the European Central Bank has done a reasonably good job. I think the LTRO is actually exceeding our expectations. I was very skeptical when they initiated it, and yet it has done far better than I would have thought. Now, does the existence of the euro prevent a more rational adjustment process? Look, I've done a lot of work correlating exchange rate movements and macroeconomic performance, and I can tell you exchange rates are not an adjustment instrument. Exchange rates are a shock propagator. And you could see that even in the Greek example where I showed you that even though it had a significant relative devaluation or depreciation in its nominal effective exchange rate, the impact on its inflation was more than offsetting. Same in the case of Portugal. That would be the case again. And so what we would end up with is not an increase in competitiveness for Greece, but a worsening of Greece's competitive situation. And so then that leaves me with the international support for the firewall. I actually think it's crazy that the Europeans can't finance a firewall themselves. I think it's crazy. But there are very strong political reasons why the Europeans want to involve the IMF in any kind of firewall proposal. I think the Europeans are going to have to grow up on that one and deal with those political problems far more than fighting battles to impose austerity. I think we need to teach people about the importance of lender of last resort facilities and about our ability to manage intelligently central bank policy without monetizing the debt and creating a wave of inflation that's reminiscent of the 1920s. Because that's what we're afraid of. We're afraid of of a demon that's long dead and buried. So.
Can I just very,
Do
very
you want
briefly?
to say anything?
But just on the Eurozone thing, I mean, you identify one problem, but I think there's another problem, which is it simply relaxes pressure on the less well-performing countries to actually introduce the sort of policies that they should. I think that's why Germany won't even countenance the idea. I think that's all. Yeah.
Okay, well, I think we obviously have not exhausted our interest, and we will obviously continue to follow intently. Thank you very much.
Thank you all.